Since we paid a very expensive course fee, we did not dare to tell anyone, not even our parents. No one knew we bought any overseas properties until we finished the renovation and rented them out successfully. The first insider secret: don't randomly buy anywhere in the UK, but only cities that are within the Golden Triangle area. For the properties I invested in, the rental yield did improve over time, and in fact, I got the chance to increase the rent almost every year. For example, my property in Yorkshire started with 6% ROI, has increased it to over 10% this year. Why I bought my first UK property in Brexit without willing? Many people talk about investing in overseas properties these days. Countries like the UK, Australia, or Canada are a hit. But 5 years ago, investors were so worried during Brexit. You know what? That's when I started investing in UK properties. Looking back, I found myself quite lucky to capture this golden opportunity. If you are new to my channel, I'm Raymond. I used to work in an US investment bank and have now become a full-time investor and entrepreneur. If you are interested in overseas property investments and building your own passive income, in this video, I will share why I chose to invest in UK houses during Brexit and 3 insider secrets of how UK property investments actually works. It's not what most people think. Are you ready? Let's dive in. Many friends ask me, why were you so brave to invest in second-hand houses overseas? What's even more shocking is that I never visited the houses in person before I purchased them. Do the houses even exist? Who knows if it's a scam? In fact, there's a lot of negative news in the market. Many people were scammed by developers who collected deposits for off-plan developments, but they have never been constructed. Real estate agents promised investors unrealistic returns but ignored the taxes and fees. This list goes on and on. Before jumping into more shocking news, let's first rewind to what happened 6 years ago. My journey into UK property investments started quite unexpectedly. So one day, my wife saw a Facebook advertisement about how to invest in UK properties. Since then, the same ad kept popping up and got her really curious. She shared it with me and I was like, babe, it's gonna be a scam. But my wife insisted and said something I couldn't refuse. It's just a free seminar in a 5-star hotel. What could go wrong? We can leave anytime if we feel skeptical. At the end, I said, okay, why not? Since I was still very reluctant to go. At the end, we arrived an hour late. All the seats were taken at the back, so we had to walk all the way to the front row and we literally became the spotlight. Something unexpected happened after 30 minutes. I found the presentation very comprehensive and logical. The strategy and the return made sense, and I was convinced. Towards the end of the talk, I think I was even the first few attendees to sign up for the investment course. So fast forward to today, not only have I built a solid passive income monthly, what I learned also changed my investment mindset completely. So why did I start investing in UK properties during Brexit? Well, the answer is simple, because I finished the course during Brexit. At that time, the market was full of uncertainties. Many investors adopted a wait-and-see approach. People feared a market crash and wanted to sell their properties. They worried the economy could get even worse. Since we paid a very expensive course fee, we did not dare to tell anyone, not even our parents. No one knew we bought any overseas properties until we finished the renovation and rented them out successfully. During Brexit, the average price growth slowed down a lot. According to the UK House Price Index, average house prices increased by just 1.3% in 2019, down from 3.3% in the previous year. In some areas like London, prices even fell. According to HMRC's UK property transactions statistics, there was a 12.4% decrease in property transactions year over year. The pound GBP also depreciated by 10% in 2019, making UK properties even more attractive to foreign investors. I remember I kept buying GBP as the price went down and my average FX rate to Hong Kong dollars was just around 9.5. If we analyze it now, this seems like a good opportunity to buy at the dip. But when we are in the middle of that situation, personal thoughts would cloud judgment. I've come to realize that there will always be reasons not to invest, whether it's Brexit, inflation concerns, or recession fears. These headlines will never get you there. I've learned that success comes from looking beyond these temporary market conditions. Since the house price dropped and GBP depreciated, it gave Hong Kong investors a very lucrative return. So I decided to go ahead and try it out. Investing in UK properties has many insider secrets, only if you do them right. You will make a profitable investment. Today, I will share 3 tricks with you. The first insider secret: don't randomly buy anywhere in the UK, but only cities that are within the Golden Triangle area. It refers to the triangular area formed by connecting London, Manchester, and Leeds. Cities within this area are worth considering because they are connected by the motorway system. The most common transportation in England is not buses, trains, or subways, but cars. Therefore, cities near the M1, M6, and M40 motorways are more convenient with more economic activities. Businesses also tend to establish their headquarters or branches there. For example, driving from London to Manchester takes 4 hours, Manchester to Leeds 1 hour, and Leeds to London 3.5 hours, all via motorways without a single traffic light. If you buy properties in Southampton or Newcastle upon Tyne, it's like buying in Tin Shui Wai or Ap Lei Chau in Hong Kong. Non-residents rarely visit those areas, so economic activities and population growth are slower, making them less attractive for overseas investors. Second, I only invest in second-hand houses, especially terraced houses, instead of apartments. Investing in houses and apartments are 2 different stories. I think this also applies in other countries. Apartments tend to have oversupply because with the same lot of land, developers can build so many units. It's hard to rent a good price when there are so many similar units in the market, and it's very hard to differentiate and stand out in the competition. 5 years ago, I visited apartments in Manchester and Birmingham. There were many catalysts saying Birmingham was the next London. Even HSBC was moving its headquarters over. We almost purchased an apartment there, as we like the environment too. The thing about new apartments is the interior design, the clubhouse looks so nice. You can easily mix up and forget you are an investor but not living there. Luckily, we didn't buy it. Recently, I checked the apartment price, and there isn't much appreciation at all. However, I believe management fees have increased a lot in the past 5 years. Turns out, focusing on second-hand terrace houses was a strategic decision because they are more affordable. They tend to offer higher rental yields with a consistent demand from young families or blue-collar professionals. Most of the time, they're located in established neighborhoods, meaning they can benefit from existing infrastructure, local amenities, and transportation links, which are important to attract long-term tenants. With proper renovations, investors can add value and increase the rental income over time. Third, the 6% net ROI rule. I have this 6% net ROI rule whenever I purchase properties. The net return on investments, meaning everything after tax, letting fees, and maintenance, must be above 6%. If the net return is only 3 or 4%, I feel like it isn't worth taking the risk. Why not just place it in the US Treasury? If you want to learn more about this net ROI rule, remember to watch this video next. I have shared in full details and reviewed the secret formula. To achieve a higher return, another insider secret is to purchase BMV properties. BMV refers to below market value properties, meaning owners are willing to sell at a discount for different reasons. If the purchase price is high, given other costs are pretty standard like stamp duty, agent fees, and renovation, it's almost impossible to achieve 6% net ROI. So the timing to enter the market to source for a good bargain is the key. During Brexit, I found many below market value properties, so it was very tempting to start my first deal. You may ask, even though the purchase price is low, what if there isn't any demand? What if no one rents it? The return is only on paper. However, after a detailed research, I learned that the downside risk was limited for 3 reasons. First, the housing shortage in the UK is a buffer against significant price drops. The National Housing Federation estimated a shortfall of 4 million homes in England in 2018. Second, the Bank of England kept interest rates low at 0.75% in 2019, made mortgage more affordable. This also supported property values. If we look at historical data since 1952, it shows that UK property prices have consistently appreciated. According to Selvers, despite short-term fluctuations, UK house prices has risen by 365% over the past 70 years, even on an inflation-adjusted basis, which is an average of 5.2% yearly. This long-term perspective is crucial. While short-term economic outlooks may fluctuate, the long-term fundamentals of the UK property market remain strong. There was another reason why I was willing to bet on it. The rental market also remains strong throughout Brexit. Now, 5 years have passed. I'm glad that this was a good call. For the properties I invested in, the rental yield did improve over time. And in fact, I got the chance to increase the rent almost every year. For example, my property in Yorkshire started with 6% ROI, has increased it to over 10% this year. Remember, this is net return, meaning after tax, letting fees, and everything. Purchasing properties at the right time with a BMV price gives investors many long-term benefits, and I just never want to sell them. It's like my own goose that lays golden eggs. Right now, I'm still looking for new opportunities. Maybe I will buy my next property when the interest rates drops further. If you want to learn more about my UK property investment journey, let me know in the comment section below. Like and subscribe to my channel so that I'll create more videos on this topic. Bye!